How
uh,
they?
my 548 finally got hit, man. My SPY. I was shouting it for the last 2 days. 548 SPY, and we just had to go through a. I don't know if you watched the debate last night. I couldn't tolerate it for more than 3 minutes, so I did not. But the market is up on maybe that, maybe core PCE, but market is looking for excuse to move. It is moving. Speaking of moving, how about Amazon, dude? That's been a good week.
Oh yeah, Amazon went crazy, and I was listening to people talk about it last night, and oh man, I wish I owned more Amazon. I'll tell you that much.
Amazon's doing some heavy lifting for me, which I'm pretty stoked about. I've got a September call at 210. My break even is 139.53, so I'm just still running with the Amazon Rivian bulls for right now because that's essentially what made the pop this week. On the other hand, we have seen some downward movement. Nike dropping about $16, and it is back down to 2022 lows, and it is not that far away from 2020 lows. So
Nike,
that's not good.
wow,
That's crazy, right?
18%, Chris. That's
Yeah, man.
crazy.
That's
Oh
a
my
big,
goodness,
big
we're at
drop.
$77 a share on Nike. I did see a little bit of the thought process as to why it was a big kind of estimates going forward. I think there was like a expression from executive management that basically said that 2025's numbers are going to look rough or rougher than expected, and that you never want to hear a stock that's been in decline, that's been struggling. I mean, to hear management say things are not looking good. They also, a couple other pieces that I saw on the Nike situation were that they quoted some real weakness out of China, which is a huge market for them.
Yeah.
And
Yep.
finally, I think they mentioned that they have been struggling with some of their competitors with, I think, Lululemon and also with Deckers, DECK. I saw that mentioned. So, Deckers, they've mentioned some of their competitors being a struggle for them. So, yeah,
Who the heck is Deckers?
I
Who's
don't know.
who's sport? What?
I just saw it on this
Who,
article. I
are you,
saw DECK.
do they make cargo pants, or they like? Is that who owns Carhartt? Who came back in a big way? I have no idea who that is.
Oh, that's the brand that makes UGG and then Hoka's.
Oh,
Those are the
that's right.
big
That's
kind of
okay. That's
shoes
fair, dude.
competitors.
Those are so popular. I will say I was in Australia last holiday season, and my buddy did ask me, "You're in Australia, can you pick me up some Uggs?" I was like, "Sure." So
Interesting.
I bought him some Uggs from Australia, which apparently the wool is better. So
Interesting.
anyway,
Yeah.
yeah,
So I mean,
but Nike big drop, man.
that is huge, and especially not fun to watch if you're a Nike shareholder. And there you go, you got the S&P 500 up 0.5% on today. Nasdaq
Yes,
nearing its all-time highs here.
yep.
Again, S&P, Nas, if they were to close right now, they would be right at all-time closing highs, which is remarkable. This market just does not want to go down. It seems like, Chris.
Yep, and that was my trade, 64 cents to now $2. Not a bad call option. Man,
Yeah.
this is nuts. And the probability, I mean, I looked at it this morning. There's about a 65% probability that the market wants to try to test the highs of the week. We have done nothing this whole week, Nick. Monday through Thursday, nothing happened, and then all of a sudden it gets exciting today. It is end of month, it is end of quarter. Let's see if the market can maybe finish on a positive note as we go into a holiday week next week. By the way, how are you approaching next week with holiday Thursday, non-farm payroll Friday? Are you even in town? Are you around? Do you think it's going to be a non-farm that catches everyone off guard because there's nobody watching? Is that going to be the big catalyst we really need to pay attention to, or is it just going to be a bit of a dud? And historically, the next 2 weeks are the most bullish in the market historically ever.
I think it's tough to say if you'll get. I think it will be very important to the market when it comes to next week. The jobs data, you've
Hmm.
seen some mild progress in inflation. I think that if you are going to see more of it, that labor data needs to kind of continue to cool off. So jobs data is going to be huge. You have CPI
Yep.
I believe the following week after that, which is big. But to kind of solidify this next round of, I think the concept of July being a rate hike, is it live or not? Like, is that meeting July 31st? Is it live or not? Is going to come down to NFP and CPI. So I think NFP is a really
That's
important
true.
week. So is it going to be a quieter week? Probably so with the holiday smack dab in the middle, as you mentioned. We will be working from home on Friday, but still doing a show for NFP just because it is such a important event. But of course, July 4th for fellow Americans, it is of course a celebration. So it will be probably a late night the night before, so maybe a little sleepy NFP, but still a very important.
Yep. Sleepy NFP for a sleepy Joe for a debate that nobody wants to watch. I've got all my buddies are just chirping and chiming in. It's like I don't know. I tried to watch it. I was interested in just soaking it all in, and I couldn't do it, man. So it's like I don't want to think about it until I have to. I don't know what it means. It's going to be bad either way. It's still embarrassing. So I'll stop talking about it now. But anyway, Nike's down, S&P's moving higher. You got to get kind of excited. It's like this is why you buy the haystack. The market doesn't
Yeah.
care. It's like just buy the SPY for now. And look, a correction's still due. I get it. It should be happening at some point, but now doesn't appear to be the time. The data seems to be improving. The market's ripping as long as it can, and it'll worry about it later.
Yeah.
What is that later? What is that catalyst? I don't know. Maybe it's a Trump win. Maybe it's
Yeah,
a
I mean, if
look.
you're
You
asking
can't.
me if I'm investing right now in
Yeah.
the indices, I would say probably not. If you're asking me, are you still bullish in the short term? I would say, yeah.
Yeah.
I just picked up now, Chris. I've talked to this point with Frank too. I do like particular sectors more than others, and
Mhm.
call it contrarian or boring, but I bought energy stocks yesterday.
Okay.
XLE ahead of the debates. It wasn't really dependent on the debate. I really like the setup. I was talking about this just as you joined. I think that if you're going to get an expansion in the economy, if spending is whether you get Trump or Biden is a lot, the both of them spend $1 bajillion a minute. If that's gonna keep going, energy infrastructure is another thing that I would like to have some exposure to. This is a swing trade. I've got a stop loss, so if it breaks this level, then I'm out. But playing some sectors and have my eye on some things. Like I said, I would love a pullback, but I'm not going to. I'm just going to trade sectors, wait patiently, and I've also
Mhm.
got some other plays that are going pretty well for me. I'm long TLT, which you know about. I'm kind of today mixed on that. I'm long gold and silver. I'm long Bitcoin. Some things working out better than others today, but it's been a decent month overall.
For sure. Yeah, I'm just looking at some year-to-date sector performance. We've seen, communication services now start to lead the way. The S&P has pulled back from that 15+%. It's all tech, all communication services for now. Energy. It wasn't that long ago. I want to say, was it in April, May, when we saw that bottom in April, April to May's rally? Energy and utilities were leading the way, like 9,
Mm,
10%. Actually, for a small stretch, they're outperforming the S&P.
yep.
But then you get into by the way, I did take some screenshots yesterday, some historical significance. We are at the 100th percentile of concentration.
Interesting.
Yeah.
So
So
really, really concentrated, huh?
really concentrated.
You know what else?
So
You know what else was interesting? One more point just to throw in with that is that
what's that?
I think we crossed over 365 days since we've had a 2% daily pullback in the S&P
Yeah.
500. So we have not had a over 2% pullback in a full calendar year, which
Mhm.
is insane. I think it's the longest stretch of history,
Yes,
or
it
one of
is
them.
nuts.
No, it's not the longest, but it's one of them.
It's got to be one of the longest. I can probably verify that over the weekend. So, the top 10 holdings. So not just the top three, which is obviously highly concentrated. That's like 21+% on just the Apple, Nvidia, Microsoft. But the top 10 holdings in the S&P is now sitting at 32.16. That's really, really, really high.
Yeah.
Um, and I guess it doesn't mean crash. Okay, it just means that you have high concentration means high one-sided risk. So if and probably it's Nvidia. Like honestly, the one that's going to be the most susceptible to a downturn would be Nvidia because it's been so great and so exponential and so aggressive that just a little reality check on Nvidia at a $3 trillion market cap is enough to move the entire market. Probably for every, let's say for every dollar, 550, you freaking turds, man. I'm out of that call. I mean, it hit my level, but I just should be riding this thing high for the day. It's up 250.
Yeah, it's going crazy right now.
Yep. Well, good for the SPY, and I mean, it's a good direction overall.
I'm with you though, Chris. I had my VOO called away from me, so I am out of that. But it is just one of those things. An index is an index, and it trails higher over time typically. But there are also periods of time. I mean, Frank and I were talking about. I will never stop beating this up because I remember in 2022, clear as day, my account, I had a lot of long, tech, a lot of long exposure to that. Every day, it felt like the market couldn't find a bottom. And it
It's
just,
true.
recency bias is so dangerous. It's so dangerous because people are going to start believing that indices do not go down, that they go up, and you buy every single tiny dip. And right now that works.
Right.
As long as you are, for people who are listening, you see Chris and I for months now, Frank, Chris, everybody comes on here. They say the indices look so strong, and they do look so strong, but we're not saying that they look strong forever and that, you should go all in on seeing them go higher.
Right.
We're saying they look strong right now. That's for traders what you trade, but you don't necessarily go, all in or get overly convinced that they can't go down. I just think it's important to keep clarifying that because stocks and markets can completely change their nature. It's just right now the nature is up, the nature is
Yeah.
bullish.
Yeah, and just look, enjoy the participation, enjoy the direction. It does make life a lot easier. Right? I mean, when you see the market wants to go up, and it doesn't matter if it's good news, bad news. I mean, look, it was another quiet week where it's like nothing, nothing, nothing. I'm not surprised that we found a way to rip. I mean, sure, the excuse is core PCE or it's end of month, end of quarter, and the recent path is up. So it's doing the same thing. You got to wonder today, does it close above 550? Does the SPY close at all-time highs again today? I mean, it's poking, right? I mean, great. So we edge out a new high. The market's going to celebrate that in the headlines today. We're going into two of the most historically bullish months, or I'm sorry, historically bullish weeks,
Mm-hmm.
and the party probably continues. And I do think that this runway is potentially disrupted by a botched policy move by the Fed, whatever that is. But right now, it's like the market's probably right. The Fed's going to cut. Data's looking better. Um, but going into 2025, it's like, is the Fed going to be on a pretty consistent quarterly cut basis? If that's the case, historically, it's never been good for the stock market. Once the Fed starts cutting, it's never been good for the stock market because it's already been priced in. But then all of a sudden we have a reactionary Fed, and how bad does the economy get? And so all that stuff we can kick it around. But right now, I just feel like if you're a bear, you're losing. You're clearly losing every week or it's got to be frustrating if you're a bear.
Oh
So
yeah.
I think the most important thing, and you have to remember this, if everyone's thinking about the black swan event, if everyone's thinking about the outlier risk, it's important to have protection, right? A good way to do that is collar position. So if you own a stock, you have a covered call, you also have a long put, it's financed, it doesn't cost you anything. If you get the stock called away, great, you can reposition for it. If the stock goes down, you're protected the downside. You can rarely make money in a hedge, because if the whole market is down, you're going to have drawdowns. Your position is going to be less valuable today than they were yesterday if we're in this nasty drawdown. But instead of taking a 20, 30, 40% drawdown, you can protect that to maybe single digits.
Mm-hmm.
And you're essentially trying to, you know, reposition on things on sale, lower your cost basis across the board. And that's what hedging is really about. If you are positioning for the 2025 end of times, 2026 recession of all recessions, and you're doing this crazy expense or a crazy cheap out of the money put, maybe you're right. And it pays you 10 to 1, 20 to 1. But unless you're positioned to have that overtake your whole portfolio profit wise, it's just a hedge. And if you've been bearish and been hedging and been bearish and been hedging, remember this stuff costs you money. Usually hedging costs money a little bit, especially costs you positions because you're going to see things go lower. So just throwing it out there, it's like people need to understand it's so much more in the headlines now of the recession, the bad, the black swan, the this, it could get so much worse. And so I get it. But if your decision making is that's all you're focused on is just trying to not lose money, like Peter Lynch, I keep bringing this quote up because it's so perfect for today's market. you spend or you lose more money waiting for a correction than actually getting the correction.
Yeah, that's
You
right.
know,
And you
so
just again, it's such a hard thing to time or to call. And I was Frank and I were talking about yesterday, like what actually gets the market to go down. I was like, what would probably get me to actually be bearish or seriously concerned about it would be if the Fed came out and said we don't think rate cuts are happening. In fact, we think rate hikes might be the most
for
appropriate
sure.
next step. That would be a bear
Yep.
market. That would be
Absolutely.
that'd be 20% down plus. But but I can't trade based off of that. That's not
Right.
happening in front of us. That's not
Right.
material. Like that's just a bear kind of worry that you could have and hold. Do I think that the markets, will have it's simple technicals. Even though I'm bullish, I still think I need to wait for corrective pullbacks and to play it, appropriately because nothing goes straight up forever, but I'm generally still bullish on the market. I've just been wrong in thinking that we could get a little bit more pullbacks here and then. I still think
Mhm.
we will. To be honest, I'm not, sitting around waiting for it. I've traded a lot of other things this year. I've traded commodities a lot long, which have been a good play for me. And I think that I will get a chance to pick up pullbacks, whether that's, brief ones like you've been seeing recently, or maybe we do get another April where you get a little bit of a pullback, or at some point this year, maybe the election stuff creeps people out and we do see, maybe more of a July through October, you get, a 10% correction and then we kind of explode higher again. I mean, that is
Yeah.
entirely possible, but right now here in front of us, the market looks really strong and it's hard to fight it. So we'll
Yeah.
see where that goes.
We'll see. And to the downside, I mean, that CPI gap from June 11th, 12th, that would be kind of my big demand zone. If we're going to have a pullback, that's reasonable. It's not that big of a pullback, though. I mean, you're talking about a gap fill on CPI that's only 2.4%. Of course, as you mentioned, like, are we going to get a 2% day that actually has that sell off? Yes, no, maybe. I mean, we did have a 6 to 8% correction in April, so it's possible we could have a pullback. But even pulling back, 2 to 3%, okay. I mean, so it's good, it's healthy, and then we come back to trendline support, and then we're having the same conversation: was that enough of a move to disrupt the bulls for a second and then start to break this trend line and head back? If we broke this level here, let's say we come back and fill the CPI gap. Well, that would be where we're potentially vulnerable if the bulls just don't step right back in, right?
Sure.
So similar to what we did here in April. I mean, it was, and I was guilty of this. I was just doing puts. I was like, I'm going to sell it, and I didn't time it right. I timed it well enough after taking 2 or 3 losses, and then I finally made some good money in April on the downside. But I played both directions, and I've got something for you here, Nick. You might like this. I spent a lot of my time this week doing some of my core strategies that I trade. I did some testing on some of my strategies, and I just want to say, look, I've been trading for a long time, but it's nice to go back and see that the strategies you've been trading and the things you do in the markets, you can go back even further and show that if I just did that, if I just do what I do now and I did it every single week or every single month, what am I doing? And I did have some pretty good tests with that. So annualized gains on one of the strategies where this would be a trade that doesn't require any direction outside of volatility. If the market goes up or market goes down, you get paid on this strategy every single month, essentially. It was pretty solid, and even more solid was to actually give this market the edge that it already gives you, which is a 55% upside, and just trade. I call it a split spread, which is where essentially you just go a little bit in the money for a call, and then you go equidistant over current price, and you just put on a bull call spread. If that's all you did, it's ridiculous how much money you made. That annualized for the last um, 18 years, Nick. If all you did was this with a one lot trade, you annualized 12.32% a year. And all
Wow.
you had to do is be bullish.
That's
So if you did
fantastic.
both directions where you're trading either way, 8.12% annualized. You're talking about some buffers here. I mean, if I and look, if you have enough to do a one lot strategy here, a one lot strategy here, one lot strategy here. I'll give you the base, right? This is what got me all excited this week. And sorry if I'm like nerding out on this too much, but
No, you're good. It's good stuff.
7.39 plus 8.12 plus, oops, nope, 7.39 plus 8.12 plus 12.32. You're looking at a base of 27.8% a year annualized without having to own a single stock, participating in two very simple instruments, the SPY and the Qs, and being pseudo directional, very long term conservative, or one direction. And you can position for that every month. And so anyway, it's been nice to know, like, I've been doing this for the last 4, 5, 6 years. I traded options in 2016, way more sophisticated since 2020. And then including zero DTE, and it's evolved so much in the markets. It's crazy. But now it's nice to validate some of the strategies. And to stuff that you do, it's like, imagine taking some of these trades where the one underlying, like the SPY, you'd want to own the SPY, right? So like, if any of these strategies, if you're like, oh fudge, I have to take a loss, sure, you can take a loss. But if you wanted to turn it into a wheel strategy where you're actually able to take ownership and then turn it, you have the ability to repair these indexes way faster than stocks. Now, granted, you don't want to be stuck in a 2008 drawdown, or a 2018 20% haircut at the end of the year, or 2020 flash crash essentially for 30 days, 2022 nowhere to hide. So that could be ugly and painful. But again, it's like you kind of wonder. It's like, are they designed perfectly to just try to go up as much as possible,
Yeah.
right? Because it seems like it.
Oh,
They
it seems
certainly
like it.
try. Yeah.
No question, because it's been such a a difficult thing to beat, because it's a pretty hard to beat strategy. They take out the bad companies, they keep the good ones in there, and they make them bigger. So it's a tough one to beat. But yeah, that's big stuff. I mean, back testing and just testing your strategies in general is something I definitely encourage everybody to take time to do, because it gives you something to hold on to when things are not going so well. So, yep. Thanks for sharing that, Chris. And Chris, if you're good with it, I'm going to leave you to take over the show for a little bit. I think Frank will join you in just a bit.
Okay.
And before I step out, for everybody who's listening, make sure to go follow Chris Pulver on his own socials. We're going to drop a link here in the chat to go find him on YouTube. And if you're watching right now on Twitter, we've got a bunch of people watching on Twitter right now. You can find him at Real Chris Pulver. Keep up with what he's up to. And he's got the dog, so no longer needs me. He's got man's best friend. So all right, Chris,
And
you
he's
got
going
it
to
from
take over
here.
the show. All right.
Yeah.
Thanks, Nick. Have a good Friday, man.
See you too.
Thanks. All right. Russ is asking if I'm still in the Swiss yen. Yes, we took a trade this week in my flex trading room. 178.98 was our fill. We're currently up around 40, about 50 pips right now. I just went ahead and moved the stop loss to break even or better. I trust the yen like a negative amount, so I'm just moving the stop loss to break even. The yen is turning pretty nicely for the day. A little bit. I mean, the dollar yen stretched up to 161.30, and the yen is stronger on the day. The Aussie having a nice little rip as well, which is kind of interesting. Outperforming the New Zealand dollar. We're still break even on the New Zealand dollar against the Aussie. So Swiss yen, yes, we're up about 50 pips, moving stop loss to +5. The dollar yen, like I said, poked above 161. There's no sign of intervention. We just had a 161.30 top, and we've come down to 160. So we've had about a 100 pip swing. Of course, I'm as curious as everybody else is, does 160 matter? Is there going to be intervention? Yes, no, maybe. I am still participating in a very small manner to FXY for now. I did actually, I believe I have some permission now to trade FXY. Let me see if they FXY. I'm definitely too early to this trade, but I was considering a 2026 out of the money call option and make this dirt cheap. It's a little bit more expensive than I wanted it to be now. And why are they asking for $5 for 71? We're only asking for $1.55 for 70. That's weird. I could pay $1.55 for a long call at 70, or I could be $5 for a 71 and going further out of the money. That clearly isn't the right price. I'm going to try to look at some open interest levels, but there might be zero to little on this FXY. But this is my way of dabbling and dipping the toe in on the Japanese yen without getting hit in the Forex market for negative swap every single day. So I'm in about $1 drawdown right now. Big whoop. That's about it. So anyway, currency pairs, yes. How to use a FedWatch tool? That is a good question. Let's go through that a little bit today. So two things I like to look at for the FedWatch tool. It's typically bookmarked. The only thing I'm really watching, and this will change when we're coming into a Fed meeting like we have here July 31st. That's going to get us through non-farm payroll. We're going to have CPI data. We're going to have all the major news that the U.S. can digest, and then the Fed can make their decision press conference late in the month. So the one thing that is interesting is we have seen the last couple of years, the Fed has been shifting their dates. They always have a Wednesday meeting, or they always have a Wednesday, FOMC and press conference. But when they do it, it's not always the third Wednesday of the month. They have switched around where it's been the first of the month, it's been late in the month. And so July, for example, you're gonna get all the major news coming in. Probability wise, this is likely safe. I don't think this is gonna flip and all of a sudden be they're gonna cut rates in July. Probably not. But you notice that there's no August. Okay. There's no August. So there will be just FOMC meeting minutes, which I'm sure Nick and the team will talk through. That's usually a little event where the market's just watching and seeing is there any forward guidance from the Fed. But the big one's going to be, if we're still going to pause through July, it's all about September. As we come out of summer trading, we come out of Jackson Hole, where are these other central banks at? I'm curious, by the time we get to September, how many central banks have already started a cut cycle? If the Fed is going to mark the first time in 2-3 years that they cut, okay, great. Does that mean that they're now going to start cutting every quarter? Because technically September would be a Q3 cut, and December, which is the next anticipated move, would be a Q4 cut, which means you're now looking at the Fed possibly in a pattern of cutting every quarter. And they keep saying, they're like, oh, it's going to be data dependent, and maybe it is. But if they cut quarterly, then I think a lot of the good is being priced in. I mean, look, and we talked about it this week on the show. The market, I think, would love to have cuts this year, even one, even two. Initially, it was supposed to be 6 or 7, which clearly that was way off. But even having 1 or 2 cuts this year is just a little bit of a relief for the consumer, right? It breathes a little bit of fresh air into the housing market, because people can look 12 months out, 24 months out, and think, maybe a mortgage. If I overstretch and I'm close at 7+% on a mortgage, or even 6 and change, that's still a high mortgage compared to what you could have done 2020, 2021, when everyone's closing sub 3, low 2s, like awesome, amazing mortgage rates. And so I'm sure a refi is appealing to a lot of people that feel like they're overstretched and they're getting priced out of homes, but they wanted to get into something, right? So, and then you look at the people that have been on the sidelines, like rates are too high. We're at this all-time low for affordability. And all of a sudden, these people start to look at buying a house again. And so you can spur some demand. You can let inventory hopefully catch up and boost some supply in the market for housing, stabilize prices a little bit instead of it going up. And anyway, so that's all out there. I think that's why the rate cut would be important, is because it helps the consumer. Anybody with business loans, anybody with variable interest rates, and anything that's financing, if you're getting a 25, 50, 100 basis points difference over the next 12 months, that absolutely affects your bottom line as some type of borrower, some type of consumer. So I think that's a good thing. And perhaps, and this is where this like no landing, soft landing argument is coming in. If the consumer comes out of this strong, in addition to a softening labor market and lower inflation, there's still runway for these bulls to keep cooking. And that is how these projected moves on the SPY at 600 can come to fruition. I mean, if you think about it right now, the SPY hitting 600 is not that far away. I mean, if you think about where we are year to date, by the way, points alone, we're at the halfway point of the year. From 480 to 550, we're up 70 points. We're talking about a finish line up here around 600. That's only another 50 points higher. So we don't have to go as high as we just did, right? We don't have to go as high. We can perform. I mean, it's two great stretches for the first half of the year to be, up 14, 15%. And then the second half of the year, does it match? Maybe the second half of the year is lackluster. Maybe the second half of the year doesn't do anything, and we sit around this like 12 to 15% window. Remember, and everybody should know this, what's roughly, dividends or no dividends, what's roughly the annualized performance of the S&P? Who can tell me? Because if you're accustomed to a 20, 25, 30% SPY, That's not accurate, you know. It's 8 to 10%. That's what this market is capable of doing every single year, even with having 20% drawdowns, 30% drawdowns, 10% drawdowns, 50% drawdowns, right? Crazy statistics. Go back to 2008. The S&P was down 56% before it found a trough. That peak to trough was 56%. The NASDAQ was down 80%. The NASDAQ was a $5,000 instrument that pulled back to $1,000 during 2008. 80%. And somehow the NASDAQ is still the best performing index, outperforming the SPY. The NASDAQ is crazy how it recovers, but there's a little bit more agility. It's highly tech focused, obviously, with the large tech companies. And tech's had a great run, especially this last, decade, like 2011, 2012, huge run in tech. And to the point where now we're talking about all-time concentration, and it's a scary amount of concentration, but the markets find a way to just grind. And if the destination is 600, awesome. Let's participate. If we get there later, great. If we get there, after a pullback, great. I'm just going to keep following along. Position strategies, keep trading, keep it as mechanical as possible. Manage risk. That's all you can do. Okay. All right. Yep, you got it. So, okay, that's where we're at for here. Let me go back to the Fed Watch tool. So, a couple tools I use in this, I just check and see, what the probability is. So, for example, we're looking at a 90% probability that nothing changes in the July FOMC meeting. We're already at 5.25 to 5.5 for the target rate. We're already there. That's the current target rate. So this is showing that that probability remains high, that we're going to stay the exact same. So current rate right here, and it shows the probability that's going to stay the same. That's a pause. That just means the Fed doesn't do anything. Okay. Go to September. This is where the changes are happening. Current rate's 5.25, 5.5. Look at the probabilities now. 61% chance that the Fed is going to cut by 25 basis points. That is what's been up and down all year. Are they going to cut in March? No. Are they going to cut in June? No. It's been pushed around, pushed back all year. But this is now starting to stick around 60%. And this can change. This can go up. This can go down. This can go up. This can go down. It can change. But this tool, as you come into these FOMC meetings, has been spot on since 2009. So when you get this big upside probability, it's pretty much baked in that that's what's going to happen. And that's where you get the idea of buy the rumor, sell the news, because the market's already taken advantage of what the market thinks is going to happen, or what the Fed is possibly going to do. So that's your September. Go into November. If they cut in September, if they cut to 5 to 5.25, let's just say 5%, go to November. Probability is they remain the exact same. So they cut September, they pause November, and then December. Right now, the probability is edged slightly in favor of another 25 basis points. So that would be one cut September, one cut December, and then you start looking out quarterly. January, we're splitting, right? Maybe another 25 basis points. So this would be interesting. Would you cut in December from the Fed, and would you also cut in January? We'll find out. Go into March. Okay, March is at least baking in another 25 basis points from the December meeting. And so a couple things. This is just what I like to look at here. We're looking at a September cut, we're looking at a December cut, and then I go out to the end of September and see what's the market anticipated out for that far. If this is as far as this tool will stretch, by September of next year, the Fed is expected to be around 3.75 to 4% interest rates. So that's 125 to 150 basis points lower than right now. Why is August missing in the tool? Because August doesn't have an FOMC. So if there's no FOMC meeting, if there's no press conference, there's nothing here. So, and the Fed doesn't have meetings every month. Sometimes they'll release an FOMC meeting minutes, which is just the or just the release notes, but they don't do an actual Powell at the podium talking through Q&A, giving a canned statement. I mean, the guy's been doing that for 4+ years. So if it skips a month, it's just because there's no FOMC meeting and press conference. There's minutes only. Okay, so think about this. Could consumers benefit from mortgage rates being down 100 to 150 basis points? Yes. Could businesses benefit from borrowing at 100 to 150 basis points cheaper? Yes. If you're refinancing any type of debt, could you benefit for 100, 150 basis points lower? Yes, right? Like this is a good thing, okay? The trick here, though, is historically when the Fed has gone into a cut cycle, it's usually because of something that's wrong in the economy. That's what's going to be so interesting about this time is right now, there's not anything really wrong with the economy per se, right? You could argue that. Some people feel like, oh my gosh, this is the worst economy ever. Things are worse, higher inflation, blah, blah, blah. My wages aren't keeping up with inflation. I get it. It doesn't feel as good as what we're seeing here. We're talking about this market at all-time highs, shrugging off all sorts of crap to go to all-time highs, and people don't feel like it's great, you know? But maybe we're just unhappier. If you think about it, we're so inundated with noise and minutia, it's like people are just unhappier. So go outside, see the sun, touch some grass, get happier, focus on the present, focus on what you can control, stop stressing. We should all know this. Stress is a killer. I'm trying to prevent, I don't want any gray hair. Got to be stress free. Anyway, there's a lot of benefits to having a cut cycle, but what's going to be interesting, and this could be a cut cycle for the first time in a long time that doesn't require something breaking. That typically is when the Fed goes, emergency mode, cut mode, something is breaking. And if they can somehow orchestrate this soft landing, no landing, they can bring rates down, be a little bit less restrictive, so to speak, but maybe it's going down because all the trends are going lower and we don't have an inflation flare up again. We'll find out, right? And that would be an incredible legacy for old Powell and who was our Fed committee right now, that they can pull this off. But it's not without the Fed being highly manipulative. It's not without fiscal policy in the background pumping crazy amounts of stimulus into the economy. There's a lot of that crap that's going on. At some point, you got to wonder if this debt bubble is going to be a problem for the U.S. Yes, no, maybe. Right? Maybe we can outgrow it. I mean, debt to GDP for Japan is over 200%. We're sitting at 110 to 120. So you never know. But at the same time, the whole financial market's in it together. In some way, it's like, globalization, deglobalization, everybody's in it together. And there's going to be some crazy creative accounting going on if all of a sudden it's like, just write off the debt. Let's restructure that debt. Who knows? But I wouldn't put it past governments and I wouldn't put it past central banks to somehow figure that out. But could it get contentious? Could it get a little dramatic? Yep. And guess what? If you're still going to be trading it and investing, you got to deal with it. Whatever it is, it's like we are in the trenches dealing with this stuff head on. Sometimes we get in the weeds. Sometimes it's way too noisy. Sometimes we make stupid decisions. Sometimes we get way too emotional. I mean, here we are talking about a market this week that just doesn't care. It didn't do anything all week. And all of a sudden today, it's like, I feel like doing something. Boop, all-time highs. Okay. Well, that was easy, So Ecclesia says, does NASDAQ not climb when rates are going up and the economy is worsening? Well, the thing right now with the market cap is, the NASDAQ is hanging in there. The NASDAQ poked all-time highs again today. The NASDAQ, I mean, right now you have to remember that it's highly concentrated. The SPY is going higher because of a few stocks. The NASDAQ's going higher because of a few stocks. What is going to be important, and I think I looked at this week, is the advanced decline. I thought that was going to be Logan Paul and Mike Tyson there for a second, but did that get delayed? Okay, let's look at the advanced decline. So right now we're showing about 53% of stocks are above the 50 moving average and about 64% are above the 200. I talked about this yesterday in the show. This is a good indicator for a broader bull market. Look at the heat map today. Semiconductors, oh my Atlanta, they're coming back from the dead. NVIDIA's been down. They're coming back. Apple's up. Microsoft up. Amazon flat after a crazy good week. Amazon, tapped 200 this week from 185. Tesla's up. United Health Group is up. So we got healthcare coming back in a big way. That's probably helping the Dow. Industrials are doing all right. Energy's up there. Google is flat on the day. Meta's up on the day. But I'd say your big push today, the reason we just saw a big jump right out of the gates would be semiconductors were all red, the only real red sector, and obviously very sensitive, and all of a sudden they're green. So, you got to wonder, and I've got this trade running as well. Will NVIDIA, well, two things, right? Is NVIDIA going to come back and test the highs, or is NVIDIA going to give it all back and come back and find, a gap back at 100? No, so I'll say this. There's reality. This is NVIDIA's reality. this is NVIDIA's euphoria. The market can find either one, right? There's euphoria in the markets a lot. When they get overstretched, they get a little ridiculous, they get a little long in the tooth. The market trades euphoria. Those are bubbles, and they can last a while. So NVIDIA can still find that euphoria, and the market can still love everything NVIDIA does. But the reality is, we have I think I did this like a 5-wave move here. If I zoom out, yeah, it'd be somewhere in here. If we just had a 5-wave move, 1, 2, 3, 4, 5. Usually a 5-wave completion is a 1, 2, 3 correction. That's my reality in NVIDIA. I would like to pick up NVIDIA at $100 or less. I'm actually putting at positions where I would own it around $80 to $75. If I'm taking ownership of NVIDIA, that's where I'm going to own it. And I'll sit on it, and I'll try to lower the cost basis. I want to obviously not get it called away until the highs. But if I own it at 80 or 75, do I think I could repair it for a quick $5, $10, $15? Probably. Could I lower my cost basis? If I can't repair it, I could lower my cost basis by $5, $10, $15? Probably. Do you understand out there that if you own a stock and you trade options around it, you can effectively own that stock for free? If you are active enough with it, right? You can own stocks for free. Your cost basis can be worked so much lower over time, you can own stocks for free. That's a pretty good thing, right? And then it's all upside. But it obviously takes the understanding of what to do, and it's not easy. Obviously, it takes a lot of time to take a $140 stock and own it for free. But there are ways to, like, I'm positioned so if I do own NVIDIA, I won't take any assignment until 80 or 85. I won't own it. It'd be like under $80. I mean, I'm happy with that, right? Even if this thing crashes. I mean, is that it? Like, is this the life cycle of NVIDIA? Is this thing going to zero? Probably not. Probably not. AI has been a big buzzword, and NVIDIA's been the king of the hype. Their market share, their head start, it's pretty impressive. But there will be competition. There will be stiff competition from some of the largest and deepest pockets in the tech world that will certainly challenge NVIDIA. So investors have had a great run. It's been a big reason that portfolios are up and 401ks are up, and it's been a nice way to participate. It feels a lot nicer to be having these conversations frustrated, like, man, I can't believe it keeps going up. Believe me, it is a lot more fun to have that conversation than, oh my gosh, I can't get a win. I can't buy a freaking win. And that's what downturns look like. If we have a broad market downturn, we have a broad market bear market, it is not fun. All you are doing is playing defense, playing defense, playing defense. And if you want to trade a bear market, the best way to do it is to trade currencies. If you want to trade a bear market, the best way to do it is to be hedged and a little bit heavy on the hedge side, so you actually maybe eke out some short-term profits. Okay? But I'm telling you, it's a lot easier to be complaining about this market going up than it is complaining about the market going down. Because when it goes down, look, we're not immune to, feeling negative. We're not immune to feeling like, oh my gosh, man, I'm in some nasty positions. I mean, I'll look at my portfolio pulling back, 3, 4, 5%, 10%. I can weather the storm. I play a lot of defense. I mean, I'll be fine. But I also have to look past whatever's happening. I know that I can survive. That's the biggest thing about being in a downturn. If you know that you're confident you can survive, you'll be fine. Is a 5 or 10% drawdown the worst thing in the world? Is a 15, 20% drawdown worse in the world? No, it stings. It sucks. It's hard to watch. Okay. But if you have some confidence and faith in what this thing has done for over nearly a century, it finds a way to go higher. And you make a lot more money if you have the cash and dry powder. If the market is dropping, if you have the courage to be positioning for a recovery. Now, obviously, if you're early, it stings. If you're going to time the bottom, it's pretty much impossible. But if you are just patient and not losing your shirt every single month in a drawdown, you still have the cash and the dry powder to be positioned for something with a recovery. It might not be a V bottom. It might be a recovery that is going to take some time. But if it inevitably comes up in your longer term horizon, I've got a crazy image for you. Check this out. Okay. Right here. History doesn't repeat, but it rhymes. The odds of losing money in stocks decreases with the longer holding period. Okay. If you hold for over 20, I think it's 21 years. So this shows 20 years, you're right at like 99%. if you hold for like 21 years, in no period ever in the history of the stock market, even if you bought freaking 1929 or bought in the top in 2007, okay, there's been no period of 20 years where you haven't turned a profit. So you could have been the absolute worst trader in the history of mankind, okay, and bought the absolute top in the worst potential crisis and the worst potential depression, but within a 20-year window, you're right back making money again. Now, that's not everybody's horizon. I get it. Like if you're, 65, 70 years old right now, 80 years old right now, if you're our presidential candidates that are trying to participate in the markets, you might not be around long enough to see this market recover for 20 years if we have a nasty drawdown. Okay. Doesn't inflation affect returns? Of course it does. Inflation is the hidden tax that nobody talks about until it's right in our face. Welcome to 2020. Welcome to the last 4 years. That's inflation. So yes, inflation sucks. Okay. But it's part of our existence. It is like a naturally built-in thing that they're just trying to contain. But that's why there's the purchasing power versus. I mean, how do you find something to outpace inflation? Well, we just talked about it. If you see that the equities market can hold an 8 to 10% annual return, and you're looking at a 2% inflation, 3% inflation, 3.5% inflation, you have something historically that can still keep pace or outpace inflation. Inflation helps those that have assets. Think about how much wealthier people got in 2000 once they recovered. Think about how much wealthier people got in 2007, 2008 when it recovered. Think about how much healthier people got in 2020, 2021 when it recovered. You're looking at ridiculous amounts of disparity from those that don't have assets to those that do. Those that do make a lot more money, right? Those that can afford to buy more assets, what do they do during these crazy, scary times? They buy more assets. Why? Because assets tend to go up in price, whether it's real estate, whether it's equities, whether it's gold, something. But if it's just paycheck to paycheck, that's not good. And right now, I think in the US, around 60, 63% of US households have some type of exposure. I mean, in a way, it's like, think about what your permissions are as traders now. You can be a trader and buy an index, the ETF of the SPY for $1, $2, $5, $10. If you can park away any money, and look, and that's going to be where it's like you got to make the sacrifices. You got to stop getting your Starbucks and you got to stop getting this. And I get it. I'm not saying it's easy, right? But those that have assets have proven over and over and over again, in good times, they're good. In bad times, they actually get way wealthier once we see a stabilization and recovery. So it is a nice thing to have assets, you know? All right. That's my PSA and rant for the day. Cool. All right. You want to take a look at some charts? What do you want to see? Type in a symbol, type in a stock, type in a currency, type in whatever you want. I will have a look. Let's go about 10, 12 minutes. Right. So I am pretty much wrapping up here for the week. I did close out that SPY expiration. I do have a future trade on Ethereum that's going to be a small loss. Like I traded micro Ethereum, so it's no big deal. I'll probably sit on that a little bit longer. I'm still in. I was surprised that BITO is down, to fresh lows when you look at Bitcoin prices. Not quite behaving the same way. I'm thinking Bitcoin still finds some pretty solid support between $60,000 and $56,000. So I'm watching that range. US 100, sure. Okay. I mean, again, we look at the same thing. I pay attention to this indicator, right? It's overbought with divergence. I will be watching it closely for this reason. The reality is this. We don't have to sit here today on Friday the 28th at this end of Q2 and say this market's going higher. Look, based on what I see on the charts, okay, this with an overbought condition, this market could sit right here, right here, right here, and have a bit of a top and a bit of a sideways move. And then as a bear what your job is. A bear would be looking to see, okay, we're going to break that trend line and we're going to then start to dip. But this market also has a chance for the bulls to say, we see you bears, we see that line in the sand, we see that floor, we're just going to take it higher. So I am not a bear until this structure starts to give way. All right. So I think right now it's probably difficult to justify a blowout top in all-time highs again and again and again right now in July. I think it's difficult to justify that. The market already surprised us with 3 stocks carrying the way, being at this crazy 100 percentile of market concentration, which gives you a tremendous amount of one-sided risk on crazy market cap companies. If NVIDIA at $3 trillion all of a sudden sheds $500 billion in market cap from a decline, that's going to drag the market lower, right? And if it drags all semiconductors with it, look out. But you also know that that is crazy sensitive price action. Based on what we've seen, you can't have a stock do this and not expect to see some volatility on the way back down, right? Maybe it's 38%, maybe it's 50%, but that market is not going to correct sideways. That market's likely going to go snap, and then it stabilizes and then maybe recovers, right? But right now for the indexes, we could stretch and we can poke these highs, right? Create a little bit of a sideways movement. We could see here that we're just going to stall, but there's no sellers willing to take it lower. And I don't think the confirmation is until this thing breaks. If we break that trend line, sure, we're coming back to this area here. That would be a nice little cleanse. How much? Let's find out. Well, if we go from highs to that level there, that's going to be about a 7% correction. Same thing we had back in April. Can we recover from a 7% correction? You just saw it happen in May. So absolutely, right? So as a bear, and again, I trade a lot of both directions. I really do. I trade both directions a lot. If I believe there's volatility, which we typically get every couple of weeks with all these news catalysts, we can trade both directions and make some money. I mean, today, that 550 trade, I can get out of my SPY trade for break even today. So, I mean, I basically had a debit spread, 545 to 555, and we're up, $5 and change on the position. So there's actual value in my option trade. I can close out for at least $4.30, which means I'm going to take a small loss. If I closed out for $5, because there's still some time left today, closed out for a small loss. That's way better than, oh my gosh, I'm going to eat the whole thing. Okay. So speaking of, let me take a look. If I've got this in here, let's talk about it. So my SPY right here, 1, 2, 3, 4. Okay. I'm going to close it for a small loss. I'm just going to close it right now. We're dipping back a little bit. I'll go for, let me see if I can get 435. $435 closing. So I'm going to run through here and just manage some of these trades. And I'm going to take a small loss. This one does not have any. Okay, this one, June 28th, 1, 2, 3, 4. So small loss. Okay. If you're in Micros on Demand class, you can close it right with me. 1, 2, 3, 4. Uh, 425. Let's try to get that again. Build a 427. Okay. SPY 1, 2, 3, 4. Filled at 420. 2 more accounts here. Nothing there. And 1, 2, 3, 4 there. 410. Close it at 411. Okay. So again, thankfully the market pushed up today. I was sitting on this essentially for a full loss going into, like, if it didn't move, if we didn't get the SPY to move today, okay. And this is why I don't just trade 0 DT. It's like I believe that the market wants to have one day a week that it's going to try to do something. Up or down, the market should try to do something. So today was that day, right? Very, very quiet price action all week. And then today exploded higher. Closed yesterday 546, tapped above 550. We poked the all-time high. That's what's going to read the headlines. Congratulations. Oh my gosh, this is the best thing ever. We're watching this thing at equal highs. It's possibly a chance to take profits again, right? But I put a trade on for $577, closed out for a loss of like $130. When I win trades like this, I'm usually winning $200, $300, $400, $500. So it's fine. It's just one of many. That's the trade that I went back and tested. and that has annualized about 8% a year on a both direction SPY trade and Qs trade throughout every market, every bull market, every bear market, every sideways market. It does fine. So I know mechanically it's like I'm just taking a small loss today. It's fine. And the nice thing is I know in that testing too, it's either hitting the profit target or it's actually closing out for a full loss. So if I can take a partial loss, I'm actually helping that annualized return actually get even better. So anyway, that's the account, or that's the trade on the SPY. And then I see that's Palo Alto. I'll talk about that one too. Yep, sure. And let me just make sure that everyone's closed out. So here, close out that trade there. Yes. Okay. Positions. So June 28th is done. All the rest are out to July. All the rest are out to July. All closed out there. All closed out there. Closed out there. All those are to July. Closed out there. Okay, we're good. Perfect. Okay. So we're good on the US 100, good on the US 30. Do I trade live here every day? I'm here quite a bit. I mean, Nick and the team have me on probably 2 to 3 times a week, sometimes 4 or 5 times a week. I always, 10 o'clock spot for me. I always try to make myself available. So if they need me, I'm here. Yeah, but I'm here. All right, Palo Alto, PANW. After a big old cleanse, that was a giant earnings play that we made some nice money on. Palo Alto dropped about 31%. Well, from I guess high to low, 31%. So it's been a nice recovery so far. I mean, do you love the stock? I mean, I see some pretty solid trend line support right now. I'd still be a buyer as far as it depends on your level, right? If technically we broke back below, like let's say 280, if we broke back below 280, then I wouldn't want to hold this. But if it's gonna dip and pause and try to get back to highs again, it's pretty well supported with the trend line. So that's it. I mean, pretty simple. Another thing I look at for this one, it would be I don't have any interest in owning the stock. It's $339, so I would trade options. How do I do that? Well, if I could go, let's say, down far enough and look at let's try to find it. If I went down far enough in Palo Alto, I'm pretty sure that this stock, if we're going to go up a little bit and maybe go sideways, that I could probably suck out some money on a longer term put. Let's find out. So let me take a look at it. PANW, and right here. So Palo Alto Networks. Let me look at the trade. If I did let's go out a ways and let's see how low I can go. I could do like a 15 Delta 250 put. I can collect $8, $9 in credit. Now, I understand that I, am on the verge of taking an assignment, so I'm probably just going to put in a wider credit spread. Do I want to own the shares at 250? No, but 250 is all the way down here. Is this stock going to get down to 250? Probably not. Okay, so if I took this trade, what I'm going to look for is if I did a 250 put, collected $9 of credit, I'm going to look to take about 15 to 20% of that and redeploy it, or maybe just be done with it. Okay, so I'm going to take this trade. Buying power wise, that's a lot. So I'm going to make this into a spread. I'm going to go out 20 points and reduce the buying power. Actually, I'll go out 30 points. I can up that buying power a little bit. And now it's 25.07. I collect about $5 of credit. Can I go out $50 wide? That's better. Yeah, I'll do this. Okay, so I'm going to collect $6.70. I'm going to try to get $6.75 in this trade. And let me calculate some numbers here. So if I get $6.75 on the trade, take a 15 to 20% take profit, I'm going to make $1 on the trade. Try to do that in the next 30 days or so, if I can. So let's see here. That is a 15 Delta, 50-point wide spread, reducing the buying power, so it's not just on the hook for a naked put. It's essentially like a naked put, but I'm going to make it it's just a wide open credit spread is what it is. So the 250 put that I'm selling, the 200 put that I'm buying, that is my risk. I mean, I understand there's risk in the trade, but my idea here is to let time over the next 30 to 60 days. If this decays by $1, I'm taking the profit. Okay. So I'm going to see if I can get the trade here for Let's go 6.90 on the spread and see if that will pay me. And let's go down here, take the trade. Got filled for 709. All right, so right now on the trade, I got filled for 709. If I take 15% of that, 7.09 times 1.5, I'm going to take $1.06. Okay, which means I'm going to set a debit right now at $6. If I want to hit the exact mark, I'm going to set a debit at 603. All right, so let me go back into my platform. This trade is in. Go to positions. PANW is now right here. And I'm going to close this trade out. Close position for a debit of $6. Okay, I'll do 603. I'll do it exactly mechanical at the 15% take profit. Review and send. So I got filled for 703. I'm sorry, 709, and I'm putting in a limit at 603. So my net profit will be $106. If I get that in 30 days, great. I can consider redeploying it, do the same thing over again. But that's a pretty easy trade where I don't have to be necessarily spot on with anything Palo Alto other than I'm giving myself a lot of room here. Okay, that's my spread. If price goes sideways, I will make money on this trade. If price goes up, I'll make money on this trade. If price goes up a lot, I'll make money on this trade. If price goes down a little, I'll make money on this trade. Price has to come all the way back down to this crash low for my position to be threatened. So that's what I'm going to watch for, right? Okie dokie. We good for today? US 30. Yep. US 30. I talked about that actually at length yesterday. So I like the Dow or the US 30 with a potential ascending wedge, which is like this. So this low to high swing, creating this kind of bullish posture. I do see some indecision. Okay. And you look at this, you're like, well, Chris, can't that break lower? Yeah, it could. But when you look at an ascending wedge, it's what got us here typically takes us out. We have a bullish direction, bullish trend that got us into this wedge. You notice that we're tapping resistance. So all we have to do is breach. We breach that resistance and this market can continue to run. Okay, and then you're running towards Fibonacci extensions, then you're running toward measured moves. These are good. Could we pull back and have a range? Sure, we can pull back and have a range on the US 30 as well. But to me, this technical outlook favors more of a melt up higher. Okay. Rathod, you calling me doctor? Kindly look at the New Zealand doctor, New Zealand dollar. I'm in the New Zealand dollar short right now. I'm about break even. I sold it at 60.90. It's at 60.91. We got to watch the dollar. I think the dollar is okay. I think it's postured okay, but it's just not really getting a ton of follow through. So I'm just taking a small trade on the New Zealand dollar. If it's going to be if a trade that works, then the dollar just gets a little bit stronger. New Zealand weakens, and we come back down to this level here. That's my trade. That's essentially what I'm targeting. You can see 5,900 or lower, which is right back here. Okay, Aussie New Zealand. I am long Aussie New Zealand, and I'm at break even. I'm already in it. So this one's already up. We're up about 115 pips on this currency. I put it to break even because if this thing wants to trend, this is my measured move right here. Low to high, higher low to higher high. That's my measured move. I put it at break even around 108.40, and I'm trying to get lucky, right? At this point, if I'm break even, I want this currency pair to try to get back to this high or higher. If we get to this high, I'm probably just going to move my stop loss maybe 20, 30 pips higher. I'm just going to try to trail, try to hit a measured move. So my goal is, 1150 to 1200 will be good enough, and I'll take profit on that. Okay. Dollar Swiss. Yep, dollar Swiss. I'm looking to buy a little bit lower. I still like dollar Swiss a lot. We need to break this trend line. This is a head and shoulders pattern, in my opinion, right here. Left shoulder, head to neckline. I'm looking to see if we will come back into the structure. This is my left structure. I'm looking to see if we have some right structure and then look to get on the right-hand side of the trend line. If we can do that, I like dollar Swiss long. I'm already in it. So I've been buying it at this low. I bought it on the trend line break. I was positioning here. I bought in at like 85 and 84. I mean, I'm in. Why? Because it's positive swap. So my dollar versus my Swiss is a positive swap trade if I'm holding this. So I get a little bit of cash every day in my broker account. If it pulls back a little bit more, I understand I'm going to be in a positional drawdown, but that is my measured move. When it's all said and done, I'm looking at this to get back to 96 is my first target. Okay. 98 is my second target, and 1.00 is my third target for profit. French election over the weekend affect the euro. Are there any crazy surprises? I know that there's some extreme candidates in the French election, right? I mean, it wasn't that long ago that the French election rocked the euro dollar when we had a Head and Shoulders. When was this? This would have been, yeah, this gap was a French election. I remember that because we had a bullish Head and Shoulders, and that French election went gap and never looked back. I don't think it's the same as 2017. It is now. But yeah, it's going to be something to watch. I mean, if it's over the weekend and we have big gaps on the dollar index around the euro, then let's figure out how to trade it. But for right now, I'm just a spectator. I think the dollar index is, euro's heavily weighted for the dollar index, so I'm following right now. I think the dollar index is still leaning slightly bullish. So I'm short the euro dollar for right now. And if it changes, I'll get out. I'll get stopped out and I'll reposition. But it's garbage. Like, it's chop suey right now. Dollar's tough. Aussie dollar sideways. Yen's doing the yen thing. So currencies for me are not super exciting at the moment. I'm just staying invested in my Swiss pairs and trying not to lose money on anything else. That's pretty much it. But obviously, let's pay attention to it, see if it has a big, big fat gap in the Forex market, because usually gaps get filled, but if they don't get filled, there's something very, very large behind it then, if that's the case. Okay. All right. It is 11:07. Let's wrap it up here. I'd probably go a little bit longer like I did yesterday with Frank if we were tag teaming, but I'm going to jump into another session here at 11:15. I'm going to jump into my equities on my trading room, and we're going to wrap up the week. I got a couple more classes ahead. So thanks for being with us today. Pound CAD, I like that one. Come back and see us next week here. Pound CAD, I like. Euro CAD, I like. We'll talk about that more next week. Okay. Yep. Thanks for posting that. If you guys want to follow me out there on YouTube, I joined the A1 trading team and Nick quite a bit. So, a couple times a week at least. And then on my channel, youtube.com/Chris Pulver, I've got a Discord channel, all that stuff. You want to follow me, free group chat, ask me any questions, do a lot of private instruction, have trading rooms. I've been doing it for a while. So happy to help. I'm just a trader. So, but I've seen a few things. So I've been trading for 20 plus years and still going strong. Sounds good. All right, Equities on Demand students, I will see you in about 7 minutes. And everyone here for A1 Trading, thanks for tuning in on YouTube, on Twitter, wherever you're watching. We appreciate it. Hit the thumbs up button, like all the stuff, help the YouTube algorithm, and we'll see you soon. Have a great weekend, everybody. Bye.